Good afternoon, everyone. Thanks for joining us today. I see a lot of familiar names out there, so glad you've joined us. Welcome back. For those of you that are joining us for the first time, I'm Allison Scobber, Consolidated Planning Group. We are a holistic special needs financial planning firm. We're nationally certified as Social Security advisors and members of the Special Needs Planning Academy. If you've joined us in the past, you know we do a lot of advocacy, a lot of webinars and planning for special needs. And today we're going to be talking about the income tax issues for the Special Needs Trust. And what I will say is that there are never ending questions on the taxation of a special needs trust and what you can and cannot pay for out of a trust, and how payments from a trust may affect various benefits that your loved one may be getting. And those benefits that I'm speaking of are both SSI, Supplemental Security Income, and SSDI, Social Security Disability, are also, we have a lot of family members that might be getting childhood disability benefits, formerly called DAC, Disabled Adult Child. And those are two different programs, and how benefits affect are different, and we're going to talk about that today. So I always like to talk about housekeeping items. We are in webinar mode today, and what that means is that we can't see you or hear you, but we do know that you're here. We're glad that you've joined us today. We do invite you to put your questions in the chat box. If you wrote in a question, if you sent in a question ahead of time, I do have all of those questions. We're going to get to as many questions as we can during the time that we have together, favoring getting through the slides and the material, because a lot of the material is going to answer some of these questions. So we do invite you to put additional questions in the chat box. If you already sent your question in, like I said, I do have that, and we'll be reading through those questions as well. So having said that, I'm gonna turn things over to Teresa, and we're gonna get started right away on this important topic. So thanks so much, Teresa. Teresa Ferruzzo, she is a CPA. She's a CPA that we commonly refer to because we do believe when it comes to planning for special needs, whether you are working with an attorney on your legal documents, we think you should work with a specialist that's nuanced in special needs. Whether it's the financial matters, we want you to work with a specialist. And when it comes to accounting and taxation and things like that, we also want you to work with a specialist that is nuanced in special needs. And that is why we commonly refer to Teresa. So having said that, Teresa, I'm going to turn everything over to you.
Okay, thank you, Allison. Welcome, everybody. I've given this presentation a few times, and so just wanted you to know that Allison's group has provided me with prior questions from the panel and from the attendants that I've tried to incorporate in the presentation today. So hopefully I'm covering a lot of your questions throughout the presentation. If not, please speak up, and we're happy to answer any additional questions you might have. As she said, I'm a CPA, have a daughter with special needs, so I have just sort of fallen into being more of an expert when it relates to special needs trust, special needs deductions at the individual tax return level as being a parent. So naturally, I'm living the life, so it becomes more real and more understanding as I'm working through all of the tax related issues. So we will get started. And today we're going to talk about why a special needs family should consider a special needs trust. We're also going to talk about the types of special needs trust and tax implications surrounding income, gift, and estate tax. Okay, here we go. I'm going to focus primarily this presentation, after we talk about the two different types, my presentation is going to be focusing more on the most common category of the trust that we use in special needs estate planning, which is the irrevocable third-party special needs trust. But I'd like for you to kind of understand the difference between the two. So the two types of special needs trust on this slide refer to the first party trust, which means that the beneficiary has funded their own trust funds, meaning it's called self-funded trust. So the beneficiary funds this trust, whether it's child support from a divorce or whether it's an accident proceed, the money comes from the beneficiary, which is the disabled dependent. On the third party side, the money does not come from the beneficiary, the disabled. It comes from a third party, which would be a grandparent, a parent, someone not being the beneficiary. So that's kind of the two main differences there. The trust maker for a first party trust can be the beneficiary, a parent, a grandparent, a guardian. Third party is always someone other than the beneficiary. The beneficiaries for each one for first party has to be disabled and under 65. There's no restriction on the third party. I mentioned already about the funding source, so I'm going to skip that. The remainder of the funds at the end of life for our disabled dependent, first party trust always has a Medicaid payback provision. Third party irrevocable trust and by nature have no Medicaid payback provision. Distributions out of the first party trust are only for the sole benefit of the beneficiary. Third party, you can have primary beneficiaries, secondary beneficiaries. There's also pooled type trust in this area where the Arc of Texas handles those. As one example, the Arc of Texas handles one of those type of pooled trust. Revocability, first party is irrevocable, third party can be irrevocable or revocable. Tax treatment on a first party self-settled trust is always taxed as a grantor trust, which means it goes on the individual tax return of the beneficiary. You will never file a 1041 estate tax return or trust tax return for a beneficiary type trust. You can file a 1041, but it only gives you a grantor letter that would go on the 1040, the individual tax return. Third parties, which is what I'm going to focus on today, is third party irrevocable special needs trust would file a Form 1041, which was a whole separate tax return with a whole separate set of rules.
Okay, I just wanted to make a couple of things because this is a really important slide and there's a lot of confusion between the first party and the third party. So the first party is the individual's money. Like she said, it could be a settlement, a lawsuit, child support being redirected to a first party special needs trust. So there's not a reduction to SSI would be an example. It could be scholarship refunds. Maybe you've got a disabled kid going to college and they're getting scholarship refunds. That's first party money. And so having a good understanding of the differences of the first party and the third party special needs trust, and we have entire webinars on first party and third party special needs trust. And this is not that webinar because we're really talking about the tax, questions as it relates to these trusts. But the third party special needs trust is how we leave money properly to an individual with a disability to preserve eligibility for state and federally funded programs, and there is not a Medicaid payback. Sometimes people have both a first party and a third party and they need it. Oftentimes people don't need a first party special needs trust. It really just depends. So I just wanted to mention that. And we had a question today about, can you take the SSI money and put it into a trust? And the answer is yes. But the SSI money is the money of the individual with a disability. It's not your money. So you can't gift that money to a third party special needs trust. So if you wanted to put SSI money into a special needs trust, it would indeed have to be a first party special needs trust that does have a Medicaid payback.
Okay, we are the two types of trusts that we're going to be talking about today are first party, which, as Allison mentioned, the disabled individual uses their own assets to fund that trust. It's their money. It is not given from someone else. It's actually their money. Third party means someone else establishes the trust with the disabled person as the beneficiary. Form 1041. What a 1041 form is a form, it's a U.S. income tax return form that you file, similar to your individual Form 1040. And it's used by most trustees and other fiduciaries to report income to the federal government. It is not required unless the income earned from the trust is $600 or more. And then at that time, you may have a filing requirement. I did want to mention that there's always a mix-up between what the IRS defines as income and what the Social Security Administration workers define as income. And so I always like to incorporate this in with the presentation because for tax return matters, it's completely different than what Social Security workers think of. So for tax matters, taxable income for the beneficiary, it comes in the form of a distribution that comes out of the special needs trust that goes to the individual tax return at the 1040 level. It also, taxable income could also include wages. If you're disabled, has a small job, it could also include investment income if they have a little bit of interest income or dividend income coming to them in the form of a 1099. Benefit income for the purposes of SSA, which the IRS doesn't look at any of this. So there's always a difference between taxable IRS income and benefit income in the eyes of the government. And for the purpose of the government income, benefit income, it could be cash that's sitting in the bank account. You could give your child cash. It also can be, they also deem it, if you provide something like funds that will pay for shelter, the SSA will deem that as in-kind support and count that as income for them, even though it truly is not taxable income. In the eyes of SSA, they consider that it is in-kind support, and you could have consequences with your SSI income.
So can we have
They
an
did.
example? Like let's say a special needs trust makes a distribution to purchase a car for said individual with a disability. Is that taxable income?
So if the third party special needs trust pays for a new car for the beneficiary, if that special needs trust did have earned income into the special needs trust, let's just say it earned $1,000 in interest income, then yes, that $1,000 could be passed to the beneficiary on a K-1, and then it would have to go on the beneficiary's tax return at the individual tax return level. I did have a correction on this slide though. I think it was back in October, and Allison, correct me if I'm wrong, but they did stop using food as part of the calculation of in-kind support. So scratch the food part out of this slide. So needs-based would be for shelter. That would be for rent, mortgage payments, property tax payments, utilities.
Okay, so one question that we have is if a grantor of a revocable third party special needs trust owns a life insurance policy of another individual payable to the same revocable special needs trust, and the individual dies before the grantor dies, is that a taxable event?
I repeat it one more time.
Basically, if the life insurance is owned by the special needs trust and the life insurance is on the individual with the disability, the individual dies and it is paid to the special needs trust, is that a taxable event? Life insurance usually passes tax-free to heirs, but in that event, it would not be a taxable event?
That's right.
Okay,
Life insurance is not a taxable event.
okay.
Okay, so the primary focus today, as I mentioned, because this is where you have a lot of tools and a lot of areas where you need to plan properly, and it requires help of a team like Allison and a CPA that understands an attorney. And this is for the third party irrevocable special needs trust. So where this trust is created, the trust will have its own taxpayer identification number, just like an individual has a social security number. This trust will have its own taxpayer identification number. If it earns more than $600 a year, that means unearned income. So it could be interest of $600 or more. It's required to file an annual federal tax return called a Form 1041. Depending on your state, you will also have you could have state filing requirements. We're in Texas, so I don't get into a lot of the state issues, but you will want to check with your particular state because you may have to file a federal return as well as a state return. What is a qualified disability trust? So, most of the special needs, third-party special needs trusts that I am working with currently and have been working with have qualified for the qualified disability trust. And it's a good thing because it allows you to have an additional exemption. Typically, your exemption for a complex trust is $100, meaning if you have income in that trust of $1,000, you get to exempt 100 of it from taxes, and then you're paying taxes at the trust rate for the $900. However, for a qualified disability trust, you are allowed a $5,050 exemption amount, which means you can earn up to that amount of money before $1 is even taxed. So it's a good thing to have that box checked. There are some definitions of it, which we'll cover next. For the trust to become eligible for a qualified disability trust treatment, you want to make sure that it follows these rules. So you want to make sure it's irrevocable, established in the sole benefit of the disabled beneficiary. The disabled beneficiary must be under age 65 at the time the trust is established. It must have a disability that is included in the definition of the Social Security Act, which I'm not listing all that here, but you can look that up. It must be a third-party trust, which means it's not the beneficiary's money that funded it. The trust cannot be funded at any time by the disabled beneficiary with his or her own money. That is a first-party trust. If the person funding the trust during his or her lifetime also serves as trustee, the qualified disability trust status may not be attainable. Most special needs trusts are funded by parents and are set up as irrevocable trusts for the benefit of the children. So most third-party irrevocable special needs trusts would qualify to be a qualified disability trust. This leads into the difference in tax rates. So trust tax rates are very high, very quick. So I listed the amount. So you'll see that a trust will be taxed at a 37% tax bracket, 37% for income at $15,650. But if you are an individual and you do tax planning and you pass the trust income down to the individual with tax planning and distributions, you actually don't reach the 37% income tax bracket until the income would be over $626,000, which likely would not happen. So there is a big difference, and this slide's really
let's
important.
stop here because I think there's a lot of confusion on this. So basically what you're saying is, as it relates to a special needs trust, as long as you're distributing the income to the beneficiary, that's how you avoid being taxed at the 37% rate, is basically what you're saying.
That's correct.
Under
So
the
it's required.
$626,350.
Yes.
Okay.
Yes. Okay, so you'll hear us talking in tax planning world about a K-1. And so people are sometimes wondering what a K-1 is. And a K-1 is the tax form that gets issued when you file your trust tax return, your Form 1041. And if you're passing funds or paying for things for the benefit of the beneficiary, the K-1 is what's used to pass the income through to the 1040 individual tax return level, because you don't want to have high income sitting in a special needs trust. You want to get it out of the trust and to the beneficiary. And so how that's done and reported to the IRS is when you file Form 1041, it will give you what's called a K-1, and the K-1 will go on the beneficiary's individual tax return. Okay, let's go over, how does a beneficiary receive funds out of the special needs trust? So, special needs trust beneficiaries, they cannot control the trust assets or receive direct distributions. You would not want to write a check for $3,000 out of the special needs trust directly to the beneficiary and put it in their bank account, because for Medicaid purposes, you can never have more than the $2,000 of countable assets. So your workaround for that is you can pay things directly out of the special needs trust, pay for medical bills directly, plan a trip to Disney for them, pay that directly out of the special needs trust. Do not let it pass through to the individual's bank account.
One question that we have is about a third party special needs trust and whether it can be revocable or irrevocable. And I've seen both. And Christina Lesher, I see you're out here, and I'm going to ask you to chime in the chat box on this. I've seen both, and what I've seen is it's a difference in opinion of the attorney that you're working with. I've seen more irrevocable than revocable on the third party special needs trust. And one way it was described to me, because I've asked this question myself personally, is that sometimes if people are going to be like leaving money to a third party special needs trust, they feel uncomfortable if it's a revocable trust versus being an irrevocable trust. Because if they're going to leave millions of dollars to the trust, for that individual with a disability, they want to make sure that that individual is absolutely going to get them. So I've seen both, but I'm asking Christina to chime in on that one. So thanks for that question.
Are we gonna have anybody
No,
chime
you
in on
can go
that,
ahead.
Allison?
And Christina
Oh,
has said in the chat box, both are okay. And the issue depends on the family members and if they're going to leave money. And yes, on what I said, like I've seen people say, yeah, we want to leave money, but if this is a revocable trust, we're not doing it. We're going to dig our heels in and we're not doing that. So that's where I've seen both. And I do think it is a matter of preference of the attorney. I've seen some attorneys that only do irrevocable. I've seen some that'll go either way on that, and I don't know that either one of them is wrong. I think it's just a matter of preference. If you've got nobody in the family that plans to leave money to the third party special needs trust and you want it to be revocable and ultimately you're the one that's going to be leaving the money, then maybe that is the right fit for that.
yes, that is definitely an attorney question, and you will want to work with an attorney that specializes in special needs trust, and they can guide you and your family with what is best for you. Most of the situations that I've seen in practice is that it is, it could be a situation where one of the parents have passed away, and the third party special needs trust then gets funded, and it does become irrevocable at that time. And so most of the qualified irrevocable trusts that I'm working with have already been funded, and they're doing what they're supposed to be doing. And that's when this tax planning becomes so important. It's really after the trust has been funded. And you will want to think about that as well with that big exemption, because the exemption really helps you.
One of the things on this slide before you kind of dive into this, how does the beneficiary receive funds out of a special needs trust? And as you said earlier, we're not huge fans of distributions directly to the beneficiary, but for the benefit of the beneficiary. And sometimes we hear a myth of that you cannot, this is what we hear, you cannot pay for food and shelter out of a special needs trust. And that's not really true. You can. But if the individual is getting SSI, supplemental security income, there would be a 1/3 reduction to SSI. If the person is getting SSDI or childhood disability benefits, then that 1/3 reduction doesn't really apply. But even still, we see things better, like paying the rent or paying if some people are living in a residential living facility or things like that, and we don't want to pay the individual directly. So I just wanted to mention that. And again, the differences people lump everything together and the benefits they're getting from the Social Security Administration, and they are two very, very different programs. If you're getting Social Security disability benefits or childhood disability benefits versus supplemental security benefits, their rules are vastly different. So understanding the two programs and understanding that for a while your loved one may be under that SSI program for many, many years until the parent retires or dies or goes on disability, and then they switch over. So what you knew is normal and what the rules were will change midstream, and being aware of that, we can help and go deeper with you guys on that.
That's right. And I won't go too far into this slide as far as how does a beneficiary receive funds out of the special needs trust. I just listed here a list of things that a special needs trust can actually pay for. So there are things that you'll want to pay for, using special needs trust fund money, and some not, depending on what benefits you are on. Okay, the ABLE account. The ABLE account becomes increasingly important, actually, when the third-party special needs irrevocable trust is funded. And before I get into this a little bit, I'll give you an example. So let's just say you have a client that we're dealing a tax return with a special needs trust. It's been funded. It earned $50,000 for the year. We don't want $50,000 taxed at that high 37% tax bracket I mentioned earlier. We want to get that money out of the special needs trust and into a lower tax bracket. So in some cases, there's not enough things that the special needs trust can pay for the benefit of the beneficiary, the disabled dependent. And so the ABLE account, which I've used it for with the majority of my clients in this situation, is you can put up to a certain dollar amount annually into the ABLE account, and that is not a countable asset as it relates to your disabled dependent.
So I just want to chime in here that the ABLE account is under the tax code 529A, and it is for individuals whose disability started prior to age 26, and it's age 46, which starts in 2026. It's subject to the gift tax exclusion, the amount. So for 2025, the amount that you can put into an ABLE account is $19,000 for the year. If the individual is working, you can put up to their earnings amount up to $15,560. So some people say, well, if they're working, you can put in an additional $15,560. They had to earn that much. So if they are working and they earned $5,000, then you could put an additional $5,000 into the ABLE account. And I spoke to a certain gentleman in Pennsylvania last week that posed a good question. And if anybody knows this one in the chat box, I did send it to the National ABLE Resource Center, and I haven't received a response back, and hopefully I will. The whole point of the ABLE account is because the money in the account's not going to count against the individual for SSI and Medicaid purposes. And then some people say, well, I heard you could put $550,000 in the ABLE account, but once that's over 100,000, then you disqualify for SSI. And what the question was is, if you have over $100,000 in an ABLE account, let's say you're not getting SSI, so you don't care about SSI, is what is the Medicaid threshold for it counting against for an asset as it relates to Medicaid? And that was the pressing question that I haven't got an answer to. So if anybody definitively has an answer to that, I will put that out there once we get the answer back on that. But there was another question that was a write-in question, was why should I have an ABLE account and a special needs trust? The answer is that they work beautifully together. An ABLE account can pay for monthly debt service for shelter, taxes, insurance, utilities and things like that without a 1/3 reduction to SSI. Whereas again, a special needs trust can pay for that, but there would be a 1/3 reduction to SSI. So I use it as a parent with kids with disabilities. I use the special needs trust and the ABLE account to play the game, to make sure that we have money in the right buckets to preserve eligibility for state and federally funded programs. And so, and the other thing that I just want to mention, we have entire presentations on ABLE accounts. Okay, so if you're hearing this for the first time and you want to learn more, check that out on the YouTube channel. You can have any state's ABLE account. Okay, the individual with a disability can have any state's ABLE account. You don't have to, if you live in Texas, you don't have to have Texas. You can have any state. And another question that was a great question that came in a few weeks ago was, I don't like that Texas has Medicaid payback on their ABLE account. So can I just go to another state that doesn't have a Medicaid payback and get that ABLE account? And the answer is no. If you live in a state that has a Medicaid payback on the ABLE account, really doesn't matter where you went and got the ABLE account, the Medicaid payback will still be applicable to you. And the other thing that I wanted to say is that there is some proposed legislation, and it's been out there, proposed legislation to get rid of Medicaid paybacks on first party special needs trust, to get rid of Medicaid paybacks on ABLE accounts, but it hasn't passed yet. So if you heard that they got rid of them, it's proposed, but it hasn't happened yet. So you can, and when it does, you guys will be the first to know. We'll definitely have a webinar on that topic, but it's just important to know some of the difference. We have someone says no impact to Medicaid if balance 100K according to ABLE disclosure docs. So this person says that Medicaid is fine even if your account is over 100,000 in the ABLE account. Again, you wouldn't be eligible for SSI, but Medicaid should be fine. Okay, so we're going to move on and we'll come back to some additional questions.
Sure. Allison, I think you mentioned this already, that
Yep.
it is, yeah, you can, those are your maxes for the year. It's basically your gift max. It adjusts for inflation every year, but it's what you can gift on an annual basis.
And just a typo on here, it's 19,000 for
It's
2025.
19,000.
And then also I wanted to mention that in an ABLE account, it's a little bit different than the 529C that a person may have heard of before. Usually a parent sets up a 529C, the beneficiary is the kid that's going to go to school later. In an ABLE account, the individual with the disability is the account owner. Now we can, link parents up to have authorization to call on the child's behalf and different things. But the child is the account owner. And whereas like in a 529C, we've seen parents where the dad and the mom both have a 529C for the same kid, and maybe the grandparents do too. An individual with a disability can only have one ABLE account, and anyone can contribute to an ABLE account. The individual, it could be their own assets, their own income. As a parent, a grandparent, a friend, I could contribute to your kid's ABLE account. Anybody can contribute to an ABLE account, but it's not $19,000 a year per parent. So like on the gift tax where each parent can give, it's up to that total amount, not doubled. Okay.
Very good. We've kind of talked a little bit about this and touched on it throughout the course today. How to minimize taxes for a Form 1041, which is a third-party special needs trust. As you recall, you can quickly get to the 37% top tax bracket quickly with just a small amount of income. I believe it was like $15,000. So you will want to make sure you work with your CPA, your accountant, in looking at what the third-party special needs trust income looks like for the year. If it's all in investments, you'd want to look at what did the investments do for the year? What are capital gains? What is interest? What is dividend? If it's a IRA that's been the beneficiary is a third-party special needs trust, is the IRA a Roth IRA? Is the IRA pre-tax money, so it's going to be taxable? You'll want to come up with what you think the income is going to look like for this third-party special needs trust tax return, and you will want to plan to get the money out of it in the form of the distribution we talked about earlier. Distribution meaning not straight to the disabled dependent. Distribution meaning I'm funding the annual ABLE account for the year. I'm going to pay for medical expenses directly. I'm going to pay for a vacation. So you will want to have some planning surrounding this as the trust is funded. That's when the work really starts, is when the trust is funded. Right now, a lot of people are kind of planning for the trust to be funded, but the real work comes in once the trust is funded.
So can we talk about when we have a third party special needs trust and there's an inherited IRA and the trustee distributes the entire RMD for the benefit. There's no RMDs in a Roth that there is on a traditional IRA for the benefit of the beneficiary each year. There would be no taxable trust income and no tax return required. Is that correct? So a Roth, the distributions from a Roth are not taxable.
That's right. So from a pre-tax, which is pre-tax dollars, it is taxable to the third-party special needs trust, but there are some rules surrounding it. They call it the stretch rule, where if you are leaving an IRA, which is pre-tax money, to a third-party special needs trust, you can actually stretch that RMD over the life of the disabled dependent versus keeping it over that 10-year stretch rule minimum. So there are things you can do. The RMDs will be recalculated, but you will want to still do the same tax planning because it is considered taxable income for the pre-tax money.
And I just want to say that there's some rules around that. It's not just a slam dunk. Like you have to prove that the individual has a disability and prove that they qualify for the stretch prior, I think it's October 31st, following the year of the death of the person who left the money, the inherited IRA or whatever. So there are some reporting requirements, and if you miss those deadlines, then you lose the ability for the stretch. So it's important to understand and familiarize yourself with some of these rules. So let's say a family member leaves a house to a revocable third-party special needs trust during the grantor's lifetime. The house cost basis is not calculated until the trust becomes irrevocable at the grantor's death, right?
Repeat it one more time.
So they're basically asking, is the cost base of the house not calculated until the trust becomes irrevocable? So if the trust owns the house, how is the cost basis? When is the cost basis of the house calculated at the grantor's death?
The cost base, if it's already named in the trust, the cost basis goes with it. If it was gifted into the trust, the cost basis is established at the time of the gift. It depends on how it gets into the trust is how you calculate the cost basis.
And so if if the house went into the trust at death, then it would be based off of what the house was worth at the time of death. But if it went in there
Correct.
before then, it would be based off the time of the gift, is what you're saying.
Correct. You do get a step up if it's at a time of death, which really that's the best way to get assets over to a special needs trust when you're dealing with something that could receive a step up in value. Step up in value is very important and very good tax planning tool to think about as you're planning what assets you want to go and fund the special needs trust. So sometimes doing things too early and putting it in the trust, depending on the asset, is not a good thing. So you have to make sure you're talking to a well-versed special needs estate lawyer when you're talking planning on what assets are you going to leave.
Are there tax differences between a third party versus a first party special needs trust? She said a
Yes.
first party child support trust
First
specific.
party child support trust is considered a grantor trust. It will not file a Form 1041. It goes on the individual's tax returns. So child support itself is not income. However, the assets or the income that you might earn on the assets while it's sitting in the first party trust will go on the disabled beneficiary's 1040 individual tax return. I hope that answered the question.
Yes, and so there's another question. There are Roth RMDs for inherited IRAs. There's not required minimum distributions for Roth traditional like Roth IRAs, but for inherited IRAs, again, that's going to go down towards the stretch. It's qualified money. It falls under the umbrella of qualified money, basically, and that's going to go under the umbrella of whether or not they qualify for the stretch or not. Is that correct?
That's correct.
Okay.
Yeah, Roth money is actually the most valuable money. Everybody wants more Roth money, so Roth money is a good asset to leave for your special needs trust for sure. You worry about taxes at the trust when it's funded, so you've got to get the planners involved once the trust is funded. I did want to mention, we're talking so much about the trust, at the trust level, the tax deductions, but I wanted to mention that, as a mom with a special needs daughter, I've taken all these deductions at the individual tax return level throughout the years. You can deduct medical expenses that you pay for as an itemized deduction if it exceeds 7.5% of your adjusted gross income. That also includes if you have to do any major home modifications, any special vehicle that you have to equip being handicapped, conference and seminar expenses, school. My daughter attends, she's always attended special needs schools, speech therapy schools, and then recently more of like a how to adult and how to act socially. All of these are considered therapy schools, and they can qualify as medical expenses in some cases. So there's also a child independent care expense. So in the summer, I like her to have more fun and less structure. So we'll put her in like really fun day camp so that both my husband and I can work. And if you and your spouse both work, you can write that off as a child independent care expense regardless of the age. So a lot of this stuff phases out, for your typical kid at 24, and with special needs, it never phases out. So, and there's also a $500 dependent deduction as well. And we'll get into dependency and if you can claim your special needs adult as a dependent or not coming up in the next slide.
Yeah, we definitely have a question at that. At what age can a disabled child file his own taxes without parents claiming on the joint return? So we'll get to that.
Mm-hmm. Okay, so yeah, there's always a lot of confusion about whether we claim our disabled adult child. I call them child, but our disabled adult dependent, do we claim them or don't claim them? So basically normal dependency rules, when you think about it, before you start considering whether you're dependent of special needs or not, they should have lived with you for more than half of the year. You have to provide more than half of the support, and they're not filing a tax return on their own. My typical son, he's young, he's not fully working yet, but for you to even have to file a tax return, he has to have wages more than $14,600 to even have to file a tax return because he's a dependent on our tax return. So, most of the time, there is not going to be enough earned income for our kiddos to have to file a tax return. There's rules around, so sometimes our kiddos will move to some kind of some kind of group home or some sort of residential home. And there is a rule that you can still claim them as a qualifying dependent if they live outside of your home, but their gross income cannot exceed the $5,200 limit in 24. I'm not sure what it is for 25 yet, but he or she cannot provide more than half of their own annual support and must be permanently and totally disabled. So once they reach of age, it becomes more about how much support are you providing to them financially on an annual basis. I think I had a question about when to file a tax return. Can you repeat that question again for me, Allison, to make sure I answered it?
Let's see. At what age can a disabled child file his own taxes without parents claiming on their joint return?
It just depends on if they've had earned enough income to have to file. A lot of my cases that are already in the special needs trust world are the disabled adult is getting a very small W-2 number, they never reach an income level to where they even have to file a tax return. If they are getting a K-1 from the special needs trust and they do have earned income exceeding, I believe the limit's now 1,300, then we may have to file a tax return for them. So it just depends on your specific situation.
Someone said, you mentioned an able account belongs to them to avoid spending it out. Will guardianship of the estate basically help for that? And it depends on what state you are. We don't see a whole lot of guardianship of the estate in Texas. And Christina, you can put the limit in there. I think that the limit isn't at 15 or 20,000 that a parent can help with without needing a guardianship of the estate. Other states do it differently, so it depends. But usually, if the individual is under guardianship, we set that up. We submit the guardianship papers, and the parent is listed on the account to transact on their behalf for the ABLE account. So we haven't seen real issues with that. But if a kid is a spendthrift, it could be an issue. We've got a good question here. I'm going to read it. I might read it twice. How is special needs trust income and realized gains allocated to the beneficiaries K-1 proportionately, assuming special needs income and gains are greater than the distribution? Do you want me to read that again?
Yes.
Okay, how is special needs trust income and realized gains allocated to the beneficiaries on the K-1? Is it proportionately and assuming special needs trust income and gains are greater than the distribution?
So if the distribution is not larger than the income that the trust earned, it gets taxed. It stays within the trust. Most of the time, capital gains, any type of capital gain asset is typically considered principal of the trust and it stays within the trust. So you want to make sure that, I've seen it both ways. I've seen it where I've inherited a trust from a former tax preparer where they've always distributed out the capital gain to the beneficiary. And as long as they were remaining consistent and that verbiage is supported in the special needs trust verbiage itself, you can stay consistent with that treatment. Typically, capital gains stay as part of the special needs trust. So it becomes really important to work with someone like Allison and their group to understand how important it is to do the tax planning, that there is no large capital gain item that can hurt the disabled dependent. So planning those assets and planning where they're invested comes into play and comes into the mix. I hope I'm answering that. But
Yes.
you always want to distribute more than it's that game of you've got the $5,000 exemption amount if it's a qualified disability trust. So you want to play with the delta between what is truly taxable income into the trust minus the exemption, trying to get the trust to do distributions during the year to push the income down, because trust tax rates are so high so quick at 15,000. Your capital gains has a tiered rate though also for both. So if you do have a capital gain at the trust level, it has the same capital gain tier as an individual does as well, which is a great rate right now. The capital gain rates are really low. It's a tiered rate. I
So
hope I'm
we've got,
answering that.
yes, we've got another question, and this is good, and I think it might be relative to a lot of people out here. What if we have a disabled adult child that does not work and only receives RSDI or DAC benefits? Do they need to file a tax return?
Typically, they do not. I think the limit, it's like I did research and I have a slide on that. I'm not sure if we got it, but typically you have to have had income exceeding $25,000 before even $1 of SSI, RSDI, or DAC benefits are taxed. So probably not, depending on the dollar value. It's not
What,
taxed normally.
sure. And one person says, if my daughter has 50,000 in the ABLE account, do I need guardianship of the estate? We typically, I mean, we run able accounts all the time for people, and we've not had to have that because the parent is listed to be able to transact business on behalf of the individual. Attorney Christina Lesher is out here, and she did mention that that number for Texas was 10,000. So if the person has more than $10,000 outside of a special needs trust, outside of an able account, then you may want to consider guardianship of an estate. And then again, what we would say is we want you to consult an attorney on these matters when it comes to, do you or do you not need guardianship of the estate? They're going to be able to talk through your very specific situation and what might be appropriate for your family. And what might be appropriate in Texas may not be appropriate at all in California. So different states do things differently. So I wanted to be clear on that. Regarding setting up a contract for renting a room in a house to avoid income, does this have to be reported on a Schedule E, even if the child is a dependent part of the household paying his share?
So I get tons of questions, and I have several clients that I do tax returns for in this specific situation. And my stance on it, basically a simplified version of it, not like quoting IRS code, is I do not take the stance of putting it on a Schedule E. We are not in the rental business. We are not trying to rent for a profit. We are not renting even at fair market value, even though you tell SSI you're doing it at fair market value. We're not. SSI does not talk to, or SSA does not talk to IRS. And I do not, because if I put our rental activity on a Schedule E, I would actually be at a loss. And the last thing you want to do is be aggressive and report a loss to the IRS on this particular situation. So I do not report it anywhere on Schedule E.
And one time a person said, from the Social Security Administration, the general rule of thumb was A, contact a CPA. B, if they're paying their fair share, which is basically their cost of the monthly debt service of the mortgage, the utilities, and back then was food, but they got rid of food, divided by the number of people of house in the household. If they're paying their fair share, it definitely doesn't have to go on the taxes. And the Social Security Administration did get rid of the fair market value last year too. So that number doesn't have to be the fair market value, because honestly, the fair market value is always much higher than what the individual even had coming in. So that was
That's right.
it was definitely a problem. So,
Yeah, and that's my stance on it as well.
okay, let's talk about gifting to a third party special needs.
Okay, gifting to a third-party special needs trust. So gifts, you have an annual limit, just like we talked about. It's 19,000 and 25. It was 18,000 in 2024. So when you gift to a third-party special needs trust, it's not considered what's called a completed gift. And that's because the beneficiary cannot manage the trust on their own because they're disabled. So IRS rules are any amount of money that's gifted directly to a third-party trust, regardless of the amount, has to be reported to the IRS on a gift tax return. It also will count if we've got anybody out there that has a large taxable estate, the amount of the gift will also count against your estate tax exemption for the year. You can, however, gift to a ABLE account, which is a workaround. Another reason why an ABLE is a good avenue when we're planning for these special needs trusts at the estate level. And you do not have to file a gift tax return if you stay within the limit, and it does not count against your estate tax exemption.
One question that I want to make sure that we get to, and I want to go back and I can one off with you on this. Somebody asked about military pensions, and a first party special needs trust. And so what I want to mention here for anybody that has a military pension, in 2015, the National Defense Act, the law changed. And basically, you could redirect your military pension. You could set up a first party special needs trust for the benefit of the individual with the disability upon your death. And usually it's like 55% goes to the spouse and the other money goes to the special needs child. For years, you couldn't name a first party special needs trust that had to be the individual's name, which could mess them up for Medicaid purposes or other public benefits. And that law changed in 2015. And it's the National Defense Act of 2015. And it's the Howard P. Buck McKeon law. I'll put that in the chat box. Howard P. Buck McKeon law that changed it to where you can list the first party special needs trust for that military pension for that individual with a disability. It's a big deal. A lot of people don't know about it, and it can really make the difference of your child's benefits and whether or not they're going to disqualify for Medicaid in the future. So I do think it's important, and I did want to mention that. I know that not everybody has a military pension, but for those that did, I mean, for years and years and years, there was nothing you could do about it. It was just a problem. But there is a fix, there is a solution for that problem going forward.
Yes, I
Okay,
have a
so
client actually that I'm working on right now that has this issue. So yes, that's super important.
okay. All
I
right,
think we
so
covered that slide. We'll move, oh,
yeah,
let's see. Yeah, we talked about that one. Okay, so still talking about preparing the Form 1041, which is the Special Needs Trust tax return. And so we've got the 5,050 exemption we talked about if it's a qualified disability trust, which helps offset income. Also, some other things you can deduct are legal advocacy fees. I didn't put on here, but tax preparation fees, because you have to do an annual 1041 are deductible. Reasonable trustee and fiduciary fees are also deductible, and trust management expenses are also deductible. I did want to point out that first party trust cannot deduct these expenses because first party trusts are considered grantor trusts, which do not file Form 1041, and it goes on the individual beneficiary's personal tax return. And currently, these expenses are not allowed by IRS rules. So wanted to mention that. Okay, takeaways are have a great team on your side that understands the special needs world. It's very, very complicated. I mean, I learn stuff every single day of the week on this subject matter. You need to have a well thought out distribution plan. You need to be able to look at year-to-date reports of what the special needs trust has earned. There are tools around it on whether your special needs is real high on the medical side. You can designate certain assets there. You want to think about the taxability of the assets that you're designating as a beneficiary into the special needs trust. Grandparents, friends, and families should put in their will to fund the special needs trust upon death. Beneficiary is a big, big problem in some cases because you haven't visited your beneficiaries on several of your accounts in several years. And it's good just to have an overall planning of what your assets are and what the beneficiaries are designated on an annual basis, or at least every couple years, especially if there's a special needs dependent in the mix.
beneficiaries are a big deal. Christina Lesher and I talk about this all the time. We beat it to death. They're also a big deal because the person that's going to leave money to a special needs trust, like if it's a grandparent or a family member, not a parent, of the individual with the disability, they don't know not to name the person outright. So you really have to have intentional conversations. It does need to go to the trust. Not individual outright and beneficiary. That if I set up my special needs trust and I have a will and I have all this stuff and I've named stuff in these documents, that's the be all end all. But the bottom line is when it comes to life insurance and it comes to account beneficiaries, the beneficiary listed on these life insurance contracts, the beneficiaries listed on these accounts trump everything. So you can say, everything goes to XYZ, but if you have a $2 million life insurance policy and you named ABC instead of XYZ, ABC's getting the money. That's how it works. And you can tie it up in court for years if you want to, but ABC's still going to end up with the money is basically what's going to happen with that. So
That's right.
we've got I know that you do consultations, and there was a lot of questions today, lots of great questions, and I appreciate people writing in and putting their questions. We didn't get to all of them. We hit a big portion of them. That we have entire webinars on SSI and SSDI and Medicaid and Medicare. We do have a template, a agreement template that we use and share with families to submit to the Social Security Administration. You can reach out to us directly on that. I'm just seeing if there was any other questions that were write-ins that we didn't really hit the high note on. Again, what I would say is from a time perspective, um,
Allison's, I think she's got some bad connection going on over there. Can you hear us, Allison? We may have lost her.
of those things.
There
And
you
then we
are.
do a lot.
Allison, you were fading in and out for some reason.
Oh, can you hear me okay now?
Yes, now we can.
Um, Bottom line is work with professionals. Work with professionals, reach out, discuss your unique situation. Everybody on here has a unique situation and you want to get it right. And when it comes to planning for special needs, it is important that you work with a specialist and that you get it right and you ask the right questions and they'll kind of lead you down the right path. So if you had additional questions today that didn't get answered, definitely reach out. We're happy to help any way that we can. We always offer free personalized consultations. You can reach out to Teresa. We have webinars all the time with attorneys that are specifically nuanced with special needs and setting up those special needs trusts, whether it be first party, third party. They help and set up guardianship and kind of talk you through what the guardianship guidelines are. And again, those guardianship guidelines are state specific. Every state is a little bit different on how they roll with that. Sometimes they call it conservatorship versus guardianship. But just reach out. We're glad that you took the time to be with us here today. Everybody is going to get a copy of today's slides and a link to the recording. And the recording is also going to live on the Consolidated Planning Group YouTube channel. It has certainly been our pleasure being here with you today. We will check out the chat box and the additional questions that we didn't get to, and we'll get back with you as many as possible. And thank you so much, everyone. Certainly a pleasure, Teresa. As you see, we had so many questions today, so it's probably going to be a good idea for us to have another webinar in the future, and we will look forward to that.
Thank you, Allison.
Thanks. Bye now.
Bye-bye.